Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Please join me in welcoming back Amitabh Bhargava to the program today. Amitabh, thank you very much for coming back and picking up the discussion on the ag sector with us today.
Good to be back, Ed.
As a refresher, for those of you who missed our previous episode or Amitabh's prior participation on the podcast, Amitabh brings more than 20 years of experience analyzing credit portfolios at Capital One, where he was responsible for, most recently, the wholesale and consumer lending practice, where he was setting up and assessing and refining best practices around credit risk strategy, risk governance, portfolio risk mitigation, and then climate risk and sustainability and strategy as well. More recently, Amitabh is a senior managing director of credit portfolio management for SRA Consulting, and we're excited to pick up the conversation that we began in our last episode around the 2024 financial forecast that was released recently by the U.S. Department of Agriculture and their Economic Research Service, and this is their farm sector income forecast report that came out. And Amitabh, you've spent quite a bit of time now poring over that data. In the last episode, I would say we talked probably thematically about some of your observations, and today I'd love to drill into the data a little bit. And for those who have not yet downloaded the white paper, you can go to the Risk Intel podcast page and grab it there. You can grab it from Amitabh's LinkedIn page as well. We're going to talk about some of the data on one of the dashboards that you pulled together there, and then we'll close out today by talking about some of the risk management implications for the agricultural sector from this data. So let's start on top by going to, I think it was page 2, if right up front in your report, where you've got a great dashboard that lays out, I'll say, a lot of the facts, really, the state of play. So perhaps you could take us through some of the numbers there and the themes that underpin that.
Yeah, certainly, Ed. Essentially, I created that dashboard or a table to provide in a summary format, like what matters for ag sector and how has that been trending. So as we discussed in our earlier conversation, 2015 to 19 was somewhat like a through the cycle or a long-term average normalized kind of period. It wasn't a boom time. The bad times had kind of wrapped up in 2014. So 15 to 19 was somewhat like representative of what a long-term average would look like for ag sector. So what we are showing in this dashboard is how does each subsequent year during COVID, post-COVID, compares to the metrics in that 5-year period, 15 to 19. So if you look at that particular table, we've listed out some of the key variables, which, as you said, the USDA economists, where they publish this data twice a year. And we've used that data to show some of the key metrics. So to start with, if you look at net cash income, that increased in wake of COVID, and it increased substantially thanks to a lot of government payments and higher prices in 21 and 22. And since 22, it's been moderating down. So it declined in 23 and then to 24. How to interpret these numbers? They really mean that, for instance, for 24, it's still 19% higher than what it was average for 15 to 19 period, but obviously it's coming down. It was 73% higher than 15 to 19 during 22. So 24 has declined. And obviously next to it, you see government payments, which have declined substantially. So they hit kind of all-time high in 20 in wake of COVID. And then they've been slowly declining, and now they are, in fact, 41% lower than the period from 15 to 19. And in our report, we talk about like what are the key drivers out there, what are the different kind of payments and so on. In terms of production expenses, obviously everybody knows that inflation was rising over last 2 years and it's moderating right now. And that's obvious out here. And that captures fertilizer prices, feed prices, the prices around the inputs which are being used by farmers. And that was about 6% higher than that 15 to 19 average in 22, further increased to 8% higher in 23, and now has moderated down to just being 5% higher than that average. We discussed last time around also about the US trade policy and the exchange rates, the impact that they have on agricultural exports, imports. So the next panel talks about exchange rates, and exchange rates today are really 10% higher than 15 to 19, as compared to most of the relevant currencies for ag sector. And what has that done? That's moderated down the ag exports. So ag exports is still are 22% higher than what they were 15 to 19, but they used to be 38% higher in 22. So that it's kind of moderated down. People don't really compare to what things were 5 years back. Their sentiments, are driven by how things are changing year on year. So on a year-on-year basis, it's kind of declining. And on the other hand, agricultural imports, they continue rising all through these years. So now they are really 57% higher than pre-COVID era. And what it's all having, the above two things are having an impact on repayment rates. And it's a survey which Federal Reserve does from ag banks, and where they ask them about what are the repayment rates they're seeing from their clients or borrowers. And those repayment rates, it's interesting that they hit all-time high just after COVID in 21, and they've been moderating down. Now still they are 14% higher than pre-COVID, so it's still better, and that's reflected in the credit metrics. But it's again moderating down to long-term average. And what determines loan repayment rates? That's your debt service ratio and your debt to asset ratio. So debt service ratios, which is what percentage of net income are you using to make your debt service? So if it is higher, that's bad. If it is lower, that's good. And what we see is it again is worsening over last 2 years. Whereas the debt to assets, that's how much debt you're using and what is the value of your assets. That's in fact, that's still improving because the farmland values have been rising. So the asset values have been rising. And that you see in the last panel where farmland values are still fairly robust, but this is across the entire country. In different geographies, situation is different. And bottom line comes down to is the delinquency rate or the non-current rate on farmland loans or ag production loans. And those ones have started normalizing. They are still far better than the averages of 15 to 19. The non-current loans are still almost half of those rates, but they've started ticking up from all-time lows, which were experienced last year. So a lot of data, but we are just trying to put everything in one page so that people can grasp it and they can make sense of it.
So let's talk just briefly about the implications of this to a lender in this space. You talked about earlier in here that repayment rates are higher than the long-term average, but falling. We've spoken earlier that it's harder to service these loans potentially in an environment where the net cash income rate is where it's at, and that especially if we do see a continued reduction in interest rates, right, on the heels of the Fed just cutting, right, 50 basis points, right, and if that continues to decrease, are we more likely to see, you know, these farmers come knocking at the bank's door for refinancing as a way to get through the current period?
Yes, and they may need, if the overall net profits they are making are low, they may seek, lines of credit, or they may need loans to fund their operational expenses. So the ag production loans, they may see a tick up, uh, and their balance sheets still look good. If there is a moderation in farmland values, then the farmland-based loans may moderate down. So there may be a higher demand for refinancing. There may be a higher demand for loan restructuring also if
Right.
the headwinds continue. So that's what possibly is expected.
Those are very interesting considerations then for the bank to be, or the credit union to be ahead of and to be thinking of and planning for. I think that you mentioned it, earlier as well, and I'm sure it's on the radars of all of our financial institutions, is concentration and the fact that there is a geographical concentration question, right? We talked about, right, these are some broad numbers, but real estate in particular is a very local value, and also you talked about it earlier a bit about some of the different input costs into the equation, and whether those are labor costs versus other kind of commodity-based costs.
Right. That's there. And on the concentration piece, I would say, as we discussed earlier, it's been a tale of two cities about crops and livestock prices this year. So livestock or poultry or egg prices, they've been stable to higher. The crop prices have been lower. So again, a diversification in terms of the portfolio of loans or borrowers specializing in these makes sense. Also, one would need to look at, like, are farmers too reliant on government support, the ones that you're banking, because that government support has been declining. So that's another piece to watch out for. But yeah, a diversification always helps.
One topic that I know is near and dear to your heart, you've done a lot of studies and research on, is climate change, and we haven't really talked about that much up to this point, although you could argue maybe it's actually implicit in all of those variables that we just looked at. But did you have anything that the data really told you about this topic?
Yeah, we have a very interesting chart almost at the end of the report, which talks about assessment of entire US in terms of drought conditions. And the drought conditions and extreme weather events, they pose a risk to agricultural production, they impact the yields, and consequently, if yields are impacted, the farm income is impacted. And around 30% of US is experiencing drought in 2024. So obviously, that does matter in terms of all this weather volatility, the droughts, floods, hurricanes, extreme weather events. All those things impact agricultural production. And although there is, ag insurance and government payments and all, but increased frequency and intensity does cause an issue. The other flip side is, there are certain environmental regulations which may also change. Like, there can be a restriction on water management or pesticide use, which impact the farming practices and their profitability. So in a way, as lenders, they may need to know what kind of practices the borrowers are using, and are they more susceptible to it. And lastly, I would say there is that consumer demand or consumer sentiment, looking for more sustainable and ethically produced food kind of stuff. And that could obviously impact demand, but it could also impact some reputational risk for banks if their ag clients are not adhering to some of those practices. So there are some of these, climate risk or non-credit risk related issues banks need to be aware of. And we can talk about a handful of other, non-credit risks, which
I'd love,
yeah.
I'd love you to pick up on that because, right, as you said there, you mentioned reputational risk, and if I think of the way within Watchtower we think of the the categories of risk, right? Certainly, credit is in there, and
Right.
a big part of it, but there's a lot more to it than that, right? And so I'd love your thoughts on some of the other key non-credit related risks that banks that are lending in the ag sector should be thinking about and monitoring.
So if we think about macro or quantitative kind of aspects, the market risk or price risk, as we discussed earlier, is matters a lot because the commodity price volatility and the fluctuations, they are determined by overall global supply demand, global trade policies, geopolitical events. So are the borrowers in a way kind of on top of it? Is the bank on top of it in terms of analyzing its portfolio? And then the input cost fluctuations also matter, be it seeds, fuel, fertilizers, that kind of stuff. And then the trade disruptions, the trade disputes, tariffs, all those things matter. So it could be more about, a strategic risk or market price risk. They need to be on top of it. The other thing is also the liquidity risk, and we saw it in spring of 23 in banking sector about the outflow of deposits, and suddenly deposits became important. Now, if we think about reducing net income of farmers in ag sector, that could create some liquidity challenges because farmers may withdraw their deposits. It may lead to increased loan demand. So that could have an impact on bank liquidity also, especially the ones which are highly concentrated to ag loans. So again, the liquidity risk management, funding management becomes relatively important for the banks.
So that's a lot, right? It just reinforces, if you will, that you can't look at this through one lens, one dimension. Credit risk is important, right? We spent a lot of time talking about that, but right from the market risk of price volatility, the input cost fluctuation, right, the trade disruption, certainly, regardless of what happens in the elections in the United States, tariffs are going to be a topic, right? Right. Whether it's been talked about or not, right? They were implemented in a prior administration. They were maintained by the current administration, and they're clearly being talked about by future administrations, and regardless of who that is. So that is a topic that absolutely is going to play a role here. And then liquidity, and right, the fact that these farmers are depositors, right? And the stickiness of deposits is clearly a key attribute as we've seen over the last year to the stability of financial institutions. So quite a bit to unpack there in the non-credit related risks in this area.
Yeah, absolutely. So yeah, it's essentially it's a very complex and dynamic segment in a way. And banks really need to adopt a comprehensive risk management approach and do these risk assessments to identify and mitigate these variety of risks.
I think that you summarized that nicely there, Amitabh, right? We have some experience within Watchtower in housing these types of risk assessments and then aggregating it all up, as you said, to there's a lot of different pieces here, right? We believe that really having that top-down holistic view is critically important. And as you highlighted, there are many inputs here that go into that ultimate equation of right, what does the holistic picture look like for across the institution? Todd, I think you concluded in your report with a a phrase that the agricultural sector is at a crossroads at this point in time, and you kind of went on to elaborate on that a little bit. And then I think you concluded with a point about the fact, though, that this segment is resilient and innovative, and so right, that is what is going to continue to happen here. And so it's going to be very interesting to see how risk management practices continue to get incorporated both into the financial institutions as well as into the farms themselves.
Absolutely. The technological changes in agriculture, sitting in our living rooms, we don't necessarily realize that, but precision farming, automation, the way it is changing out there, and how they are taking care of, responding to demographic shifts and changes in what consumers want. That's fascinating. That sector is very dynamic.
Well, thank you for sharing your insights. I know this was a lot of work to get through this data, right? It's heavy, it's dense stuff. I think you really thank you for helping boil it down into a way that's digestible. I think when we talked about some of those themes in our prior episode, here getting into some of the data itself was fantastic as well. I would encourage anyone, as I said in our prior conversation, that this white paper is available for folks to consume themselves and utilize. You can get that from the Risk Intel website. You can get it from Amitabh's LinkedIn page. Connect to him directly, or ask for his contact information for anyone at the Risk Intel team. Clearly, there's a great depth of knowledge here, Amitabh, and I know you'd be willing to share that with anyone who would like to dig in at another level. So thank you again.
Thanks, Ed. Yeah, bye.